Good day, ladies and gentlemen. You're welcome to our class Financial Management 2. Today is in chapter 6. We were talking about dividend policy. Dividend policy. In our outline, we will look into the meaning of dividend, dividend decision, policies, types of dividend, balance sheet effect of dividend payout, stock dividend and stock split, and stock repurchase. So, what is dividend? As traders doing buying and selling of goods and services, the difference they make, the difference between their cost and their selling price is their profit. But for shareholders, it is not called profit, it is called dividend. This is the benefit of their investment. We hear of shareholders, we hear of investors. When they buy shares in a company, at the end of the period, if the company makes a lot of profit, they will say, okay, let us share some parts of our income to the shareholders. Let us keep them happy. So by sharing the money they get is called dividend. Shareholders have other benefit. They have two benefit. One, they take dividend, and the second one is wealth maximization, the increasing the value of their shares, which is called the capital gain. So the term dividend refers to that portion of profit which distributed among the owners, which is the shareholders of the company. They are the owners of the company and they want some benefit out of the profit the company makes. So decision. How do the company make this dividend decision? Should the profit be plugged back to refinance the investment decision, which is should the company pay dividend or should they retain their income and expand their company's investment? Whether any dividend be paid, if yes, then how much should be paid? How much should be the dividend? And when these dividends to be paid, is it a interim or final? Is it quarterly or you want to pay at the end of the year? How do you want to pay this dividend? In what form the dividends be paid? Which will bring us the types of dividend, which is we have cash dividends, stock dividends, and many other types. But here we will focus on cash and stock dividend. So are we going to give cash? Are we going to give stock dividends to our shareholders? So these are the decisions the company makes. It is called what? Dividend decision. Should we pay dividend or should we not? Okay, and by the way, it is up to the management. The management decides to pay dividend. The CEOs, the CFOs, the board of directors, if they decide to pay dividend, then they can declare the dividend. If not, shareholders will not say, hey, come and pay us dividend. So when deciding dividend, these are the things you need to consider when deciding dividends. How much cash to distribute to stockholders, which is the shareholders. Financial managers must keep in mind that the firm's objective is to maximize shareholders' value. As you are a finance manager, as you are a finance analyst, you have to know that your main objective is to maximize shareholders' wealth. Remember in our first class that everything we learn in this class will be referred back to the first class. It is maximize shareholders' wealth. So this is also a part of the decision. Thus, the target payout ratio should be based on investors' preferences for cash dividend or capital gains. What our investors prefer. Do they prefer to receive more shares or do they prefer to receive cash payout? If the firm increases the payout ratio, then dividend one, which is the next year's dividend or the upcoming dividend, will increase, resulting in a higher stock price. Other things being equal, ceteris paribus. Okay, so when deciding dividend, however, if the firm increases dividend one, there will be less money available for reinvesting. That means they have given out money to shareholders, they have less money to reinvest. They have less money to increase their investment options. They have less money to expand the company. So if falls, this will lower their stock price. So for investing, causing the growth rate to decline. Remember, G, which is the growth, is equals to the retention ratio times return on investment. If the growth rate falls, this will lower the stock price. So if the dividend don't grow, then it will have effect on the price of the shares, which is also another disadvantage of declaring dividend. Therefore, when setting the optimal dividend policy, the finance manager should strike a balance between current dividend and future dividend so as to maximize their firm's stock price. So if you are declaring dividend today, make sure that the next year's dividend should be higher than this year's dividend. That means it shows that dividend is growing, the growth rate continues. If it doesn't grow, then the value of the shares will drop. So what is dividend policy? It is the decision to pay out earnings versus retained and investing them. Should we pay this dividend today, or should we keep the income? Should we give at least 50% to shareholders, and should we retain 50% to reinvest? So those are the decisions. So this included different levels of payment. So should we pay high or low payout? High payout is you are paying more cash to to your shareholders, either cash or stock dividend. You are paying out more. And low payout, is it low? Should we pay a lower range or lower percentage or a lower dollar amount to our shareholders? Let's say $3 per share. We issue $3 per share, which is stock dividend, or we give out 3 ringgit cash or 10 ringgit cash dividend payout. And also, secondly, a stable or irregular. Should we pay stable dividend? That means continuously over the years, over the foreseeable future, we pay this amount of dividend to all our shareholders, no matter the profit we make. Or irregular dividend. You pay this dividend, this amount today, you pay 10 ringgit today, next season or next accounting period you pay 11, or you pay less than 10. This is quite irregular and it's unpredictable, and this would affect your value of shares. So how frequent can we pay dividend? How frequent can we pay dividend, and do we announce their policy to our investors? One thing is, there are companies that cannot pay dividend. Just for your information, companies like new startups, of course they don't have enough money to grow. They have to grow their company if they have money, so they cannot pay dividend. And also the SEC prohibit companies from paying dividend out from their capital. They cannot pay dividend from their capital. Dividend must be paid from their income after tax. Okay, companies that are bankrupt also, of course, they cannot pay dividend. And companies that are which is fresh startup that issue new shares, maybe 1 year or 2 years within the range, they cannot. Small companies also, these are things that affect companies from paying dividends. Okay, so next time you invest, if you want to invest in a company, you should know if what kind of investor are you. Do you want dividend or do you want capital gain? So you can invest accordingly. So dividend policy and value of firm. The policy is basically concerned with deciding whether to pay dividend in cash now or pay increased dividend at a later stage, or distribution of profit in the form of bonus shares. Should we pay the cash out right now, or should we retain this cash and accumulate this dividend for a long period of time, then pay a huge amount of dividend out, either by cash or by shares? What is sound rationale for dividend payment in the light of the objective to maximize the value of the shares? Okay, every company, they should have different dividend policy. There is no particular dividend policy a company should follow, based on your investors' needs, based on the management understanding, based on the board of directors understanding what kind of dividend policy that can grow our company to maximize the value of shares. This is the baseline to maximize the value of shares. Different models have been proposed to value the dividend policy decisions in relation to value of the firm. There are so many dividend models that have been established. Some say a dividend is relevant, and some say dividend is irrelevant. So let us go to the relevance theory of dividends. So the relevance dividend policy, it says the firm pay dividend and view such dividend payment positively. Firms should pay dividend and view the dividend policy as positive. That means the dividend policy is going to increase the value of our company. The investors also expect and like to receive dividend income on their investment. Oh, these kind of investors, they want dividend. Let them pay dividend. They're expecting dividend. At the end of the period, they want dividend. And the firm is not paying dividend may be adversely rated by the investors. If the firm not paying dividend, then they feel that the company will be rated on the negative side. It may be argued that the dividend policy has an effect on the market value of shares and the value of firm. So this is an argument. Some researchers says that if you pay out dividend, it will not affect your company value, and if you don't pay out dividend, there is no effect at all, while others disagree. So these theories, such as Walter's model, Gordon's model, the birds in hand, and many other dividend policies, models that have been established to explain this. So the other policy says dividend is irrelevant. These supporters like Mogliani, Millard support irrelevance theory, that investors are indifferent between dividends and retention generated capital gains. Investors doesn't care about whether they pay dividend or not, but they are indifferent whether they got dividend or they got capital gain. So in these theories, one of them is like bird in hand theory. This is the first relevant theory, which is the bird in hand theory, which says investors think that dividends are less risky and potential future capital gains when they like dividends. And the birds in hand, the first one, the relevant theory, they said that the money, the cash you have in hand today is better than the one you are going to chase later, which is the bird in hand meaning. So they want dividend. And the irrelevance theory, they don't want dividends, and there are no effect on the dividend or the value of shares. So here are types of dividend. Classification of dividend are based on the form on which they are paid. Following given below are the different types of dividend. So we have cash dividend and stock dividend, which we will discuss. The bonus shares refers to as stock dividends in US, property dividends, interim dividend, annual dividend, special dividend, which is extra dividend, etc. A regular cash dividend, this is regular payment, and scrip dividend, a liquidating dividend, and property dividend by giving out property as a form of dividend payment. So cash dividend is when a company declares the cash dividend that, okay, today or at the end of this period, we are paying out 10 ringgit dividend, cash. So they will declare the dividend. We have a different dates of dividend. One, the declaration date. The other one is the verification date, where they're going to decide who is going to receive the dividend. Company shares, they sell shares every now and then. Every minute people sell their shares. So when they declare dividend, who is going to receive the dividend? So that is the date. So after the declaration date, they have to know who is in the book on that date that should receive the dividend. And at the end of the period now, the third day date is the payment day, so they pay out their cash. So this cash will be transferred into the shareholders account. So if you are an investor, you have shares in a company, at the end of that period you will receive the cash yourself. And the stock dividend is instead of giving you cash, they increase the number of your shares. However, this does not affect your the price of shares instantly. So at the end of the period, they say, okay, we are giving out let's say 10 ringgit worth of shares to our investors. So this will increase 10 ringgit or 10% of your shares. Okay, so we will quickly go into balance sheet effect of dividend payout. When you pay out dividend, when companies pay out cash or stock dividend, how will their balance sheet looks like? Okay, as a finance analyst or finance manager, you need to know this, that the dividend payment, we do not have different balance sheet for dividend payment. It is all the same balance sheet, but when you pay dividend, there are effects on the balance sheet. One of them, if you pay cash dividend, it will decrease in retained earnings. your first balance sheet, you can see that you have paid dividend. So these are the adjustment that you will make. After the adjustment, then you prepare the final comprehensive statement. That means it will shrink. It will decrease in cash balance, and also the overall, it will reduce what your balance sheet size. The size of your balance sheet will be reduced. That means you have given out cash or stock. Or if you give out stock dividend, the stock dividend will what? Have effect on what your pay in capital, because your capital pay in will increase, and your issued shares will also increase. Okay, these only affect what? Stock, and not no changes in cash when you issue stock dividend. So let's go to one of the examples to see when you issue dividend, cash dividend, what will be the effect on your balance sheet. So Real-Time Corporation Berhad has 2 million shares of common stock outstanding. Net income is 100,000. This is their profit after tax, and the stockholders' equity portion of the company is given below. They have common stock, which is 2 million shares of what? 10 ringgit per value, which gives you 20 million. Capital in excess of par, which is paid in capital, is 17 million. Retained earnings, the money they retain, the profit they retain previous years, is up to 33 million. Then total is what? 70 million ringgit. Okay, you are using dollars. So current market value of the company stock. Now the today's market value of the company stock is what? 20 ringgit per share, $20 per share. What is the question? Show the statement of financial position after A cash dividend of $3 per share is declared. B, a 10% stock dividend is what? Declared. So cash dividend will affect what? Here. Decrease in retained earnings, decrease in cash balance, and reduces the overall size. Why stock dividend will what? This 10% stock dividend will affect the paid in capital, and also the number of shares. So for this example, let's see the solvent solution. Cash dividend, which is this is supposed to be 2 million, not 20 million, please. Here is 2 million shares. Okay, it's 2 million shares times how much? 3 ringgit. We are paying out 3, right? Gives you 6 million. Okay, retained earnings after cash dividend. The retained earnings as per statement is what? 33 million. Here, retained earnings is 33 million, and net income, we have to add our net profit of 100,000. How much is net profit here? 100,000. So this will give us, okay, you have to also less dividend paid. This is our dividend paid, right? Minus 6 million, it will give us 27,100,000. This is the dividend at the end of the period, and retained earnings at the end of the period. Why are we doing this? We are doing this adjustment to see what will be the end retained earnings, because we have gotten the cash payment, dividend payment, which is 6 million, and how will it affect the retained earnings? So that is why we have the beginning retained earnings, then we add the net income 100,000, then less dividend payment, which is 6 million, and our total retained earnings is 27,100. Now we can draw up the new financial statement, which is the equity portion, which is common stock of 2 million shares at 10 per value, gives you what? 20 million, which is all the same here. Capital in excess of par value, which is capital payment, paid in capital is the same, it doesn't affect anything, 17 million. And retained earnings now changes to 27, this current one. So retained earnings, 33 was previous amount, but now we are using the current adjustment, which is 27,100,000. So when you add all of this, our balance sheet size becomes 64,100,000. Before it was what? 70 million. So it reduces the size of our balance sheet. This is the effect. So let's go to solution B. When stock dividend is declared, 10% stock dividend is declared. So when you declare stock dividend, it will affect what? Your shares and also your paid in capital. So these are the necessary adjustment. Stock dividend declared is 10% times what? 2 million shares. Remember our 2 million shares, and 10% of the stock dividend gives you what? 200,000 shares. So now we are giving out 200,000 shares as our stock dividend. So total number of shares outstanding becomes what? 2 million. Our initial 2 million plus what? 200,000. Okay, remember this is now our new shares that we are issuing to our shareholders. We add the old ones, becomes what? 2,200,000 shares. So the current market value of new shares is what? Becomes 20 ringgit, $20 shares of what? 200,000, which is 4 million. Don't use the overall, we use what? The new amount that we are issuing to shareholders, which is the new value from the equation here. The current market value of the company stock is $20 per share. So we use the current market value for only the new shares, which gives us what? $20 per share multiplied by 200. It gives us 4 million shares. Then the additional paid in capital is what? Becomes the additional paid in capital. Since we have issued new shares, then we have additional paid in capital. That means investors paid and they bought new shares. So it will become 20 minus 10, which is the new price of shares minus the old price of the shares multiplied by 200,000. The new shares gives us what? 2 million ringgit, $2 million dollars. So these are the necessary adjustments. From this adjustment, now we can rewrite our balance sheet. So Retam Corporation balance sheet after cash stock dividend. Sorry, this is stock dividend. So it will become common stock of 2.2 million. Now the stock will what? Increase. Remember the first one, it doesn't affect the stock price, but now this one, the stock price will increase to 2.2 million. Shares of what? 10 per value gives you what? 22 million. Then capital in excess will now increase, right? 17 million plus what? 2 million. Remember, old one is what? 17 million. Okay, this is our old 17 million, and this is 17 million plus where the 2 million comes about. The 2 million is what? This, the additional paid in capital. So once you add it, it will give you 19 million. And our retained earnings becomes what? 29 million. And our total becomes what? The same as what? 70 million. So this is the effect of what? The stock dividend. Okay, I have an exercise here for you to practice. Do this. H&M Inc. has 5 million shares of common stock outstanding, of which 6% income after tax, and the stockholders' equity portion of the company is given below. Okay, we have 5 million shares. Out of the 5 million, 6% is what? The income after tax, which will give us about 6% of 5 million is about 300,000, right? So that is the net income after tax. So common stock 5 million shares at 12%, 12 ringgit per value gives you 60 million. Capital in excess at par is 45, which is paid in capital. Retained earnings is 55 million, and total is 160 million. So current market value of the company stock is what? $30 per share. Question: show the statement of financial position after a cash dividend of $5 per share is declared, and B, a 15% stock dividend is declared. Okay, solve this. I want to see your result, what you get, to know if you really understand the effect on a balance sheet. So stock dividend and stock split. The stock dividend firms issue new shares in lieu of what? Paying a cash dividend. Instead of paying cash dividend, they give you the stock, like we just explained and the example we have given. If 10% get what? 10 shares for each 100% shares what will own. That means the 10% shares will what? Increase. So what about stock split? Stock split is more like stock dividend, double the number of shares. That means if you have 2 shares, you will have what? 4. Okay, they increase, they split, put into 2 and split up. So if you have 100 shares, now you will have 200 shares. They double the shares. So what is the other effect? The effect is that once the share price increases, then the value of the shares will drop. So if the share price is $4 per share, and of what 100 shares, if the stock split takes place and increases your stock to 200, then the price of the shares will drop to 2. That is from 4 to 2 as both stock dividend and stock split increases the number of shares outstanding, so the pie is what divided into small pieces. Unless the stock dividend or split conveys information or is accompanied by another event like greater dividend, the stock price falls so as to what keep each investor's wealth unchanged. That means the investor's wealth is unchanged whether the stock split takes place or not. The value of your shares is still the same, or that means only the number of shares will. Stock repurchase. Stock repurchase is buying own stock back from what stockholders as in alternative or distribution cash as what dividend. You buy back your shares, you increase the wealth of the company, increase the power to control the company. The advantage of the repurchase of shares is that the stockholders can sell or not. If they can either sell or they can just leave it like that. With a cash dividend or stock dividend, it must what accept the paying and pay out of what taxes. So it helps to avoid setting a high dividend that cannot be maintained. If you set a high dividend, if the company cannot maintain, then the value of the shares will drop. Therefore, they can buy it's more important to buy back the shares. Repurchase stock can be used in to take over or resold or to raise, as the case may be. If you buy back shares, that means you want to have more power, so you can merge or acquire other companies, and many other reasons. So this is all about this chapter. If you have any question, I'll be happy to answer them, and if you have any comment, of course I'll be glad to read your comment. And